Let me drive home what we've been talking about a little bit more, because it really goes to the heart of some of the most important aspects of trading skills. As one trader put it in my book, The Mind of a Trader, the worst I do is a 1-to-1 reward to risk ratio. Most of the time I want 2-to-1 or a 3-to-1 ratio. So if I think a stock is going to $35 and is currently at 31, then I sell at a loss if the stock goes to $29. So I have a multiple upside to downside. Now I'm going to show you an example of that in a second, but for now I just want you to sort of just get to grips with it. Just try and understand what we're talking about here. You cannot be willing to say, I am going to ride the stock to $20 to the downside if I'm wrong, but I'm going to make $4 if I'm right. You do that kind of thing, if you do that kind of thing, you're just not going to be in business for very long. And that's the bottom line. That was actually one of the world's leading traders. He was the former global head of foreign exchange at Salomon Brothers and a hedge fund manager now. And so one of the legendary traders of all time. So don't just take my word for it, take his word for it, that we really do need to be thinking in those terms. Well, let me put that to the test and show you some graphics. We're looking at Allied Domec here. We've seen the stock go down, down, down. It's tried to make a few recoveries. It's not managed to do it. So we've drawn this downtrend line, which acts as a resistance. You can see the stock sort of kissing it and then falling back, touch, fall back, touch, fall back. Here, however, today, the stock has perked up 290. It seems as if it's broken up above this downtrend line. As you can see, it seems as if it's broken up. It seems as if it's no longer in a downward move, which is here. Because even here, when it had gone up a little bit, it was still in a downward move, as you can see. Even when it had started climbing, it met this resistance, fell back. But now it seems to have broken out through that. From a technical analysis point of view, that is substantiated by the MACD. I won't go into technical analysis, this is not the CD-ROM for it. But the point is, it seems that it has started to rise and the tide has definitely turned. Well, where do we put our stop loss? Where do we put our gain? Well, the stop loss, if I can talk you through my reasoning, would be this. Where would the price have to go from 290 pence such that I would know that I am wrong, that it is on an upward trend, that I would know that I am wrong, that it has broken this upward trend, that I would know that I am wrong because the price keeps falling and has rejoined this downward trend? Where would the price have to go? Well, arguably it could go just the other side of that line at 280, but that might be a bit too risky for me. I might get stopped out as the stock just drops a little bit and then starts moving higher again, sharply once again. No, I don't want to risk it to go just there. Equally, I might want to wait a little bit longer, and I think I'm happy. If it goes to 270, I reckon I will then know that I am wrong, that this stock is no longer in an upward trend. It is actually still part of this long downward trend. So I'm going to put the stop loss at 270. Understood? Yeah. That puts the stop loss at 20 pence. What about the upside? Well, I'd reason I'm looking at the technical indicators. I'm looking at local resistance levels around here, and I reckon I'm quite happy for it to be able to go from 290 to just around 350, because that's quite a significant resistance here, and I think that's doable, given that in my experience when the MACD forms this type of positioning, it does tend to reveal a 15% rise roughly in the share price, 15 to 20% rise in the share price. So I am willing to say I reckon it's going to go to 360. So what's my gain? My gain is 60 pence. My loss is 20 pence. I like those odds. I'm willing to take that risk. Now, if I wanted, I could assign a probability to the 60 pence and say, well, I think there's only a 70% chance of a 60 pence gain and reduce that gain. But it's still going to be significantly greater than the 20 pence, so I'm willing to place the trade. Now, of course, there might be more to it, and then I might have to look at the news regarding Allied Domec, the industry. That's as an aside. At the moment, we're talking about money and risk management, and money and risk management tells us that in actual fact, we've got risk there, gain there. So what happens? as we fast forward? Well, as we fast forward, we see where the stop loss is. We see the price has moved up. It's not been going perfectly smoothly. It's sort of fizzled out a little bit, going sideways. But I, as a technical analyst, would look at all of this here and say, well, no, I'm happy to hold on because that's quite a strong rise. And even here, it's not showing me a sell signal, so I'm willing to hold. But wait a minute. Look at what's happened here. It's turning off. This is still going a bit sideways. Now, I might say to myself, well, I might close half my position and let half of it run because this might be now showing some degree of negativity. Maybe it's just not going to get to that point. Hey, don't get me wrong. I've still got a nice little profit. Got in at 290. I'd still be looking to get out at, say, 315, 310. So that's not bad. However, I might, depending on how risk-averse or risk-loving I am, I might say, well, no, I'm going to hold on for the rest of it. So either I'll close half my position. Where it's ambiguous like this, I'm willing to close half the position. Well, what happens in actual fact? What we see, therefore, as this price has been falling and then going sideways, when we look at the weekly chart, is a different picture, and that's why I like to look at this. Now, this is, again, a bit more to do with technical analysis than it is to do with daily price charts. However, the principle still applies, which is, when I look at the weekly chart and I see a strong growth in the MACD here, I think, oh no, I definitely want to stay in. I know it's a bit weak and feeble on the daily chart, which we just saw, but on the weekly one, it's not, and that's what keeps me happy and keeps me wanting to stay in. You see, that's the daily chart that we just saw. It's a bit weak, but I looked at the weekly chart and bang, it's rising. So I stay in. So what then happens? Well, it hits our target. Fantastic. And we've done the right trade again, going lower. Here's the downtrend, the MACD, technical indicators there, but the money and risk management was there. We kept low here for one reason or another, whatever it is, it doesn't really matter. Then we moved up here, and that was where risk and money management gives us a return of the types we want. Actually, I just want to show you this picture here, and the reason is it shows you diagrammatically a little bit of what we're talking about. Stop, buy. We're waiting for it to break above. This is the price. It's going like this. We're waiting. That's a trend line here. We're waiting for the price to break above. As it does, we buy, but we put a stop very close there. That's what money management's about. It's about, and risk management, it's about focusing on this area far more than we focus on that or that. We're focused on this. That's what many people forget to do. Okay, let me move forward. Again, we're still on the topic of risk management. Let me move forward and talk a bit more about this area. I am very risk averse. I would definitely take the certainty of making $10,000 than the 10% chance of making $100,000. Bernard Opperty, who at that time was global head of equity options trading at Banque Paribas, the French bank. So, what does he mean? Well, I'm going to tell you in a second what he means. Big problem, as I was saying, the problem that many traders have is the anticipated fear of losses. What they tend to do is they're so afraid of losses that they get out of their positions too quickly very often on the profit side, or they'll let them run, those losses run and run on the loss-making side on the basis that unless they take them, they're not facing a loss. Well, all that's all well and good, but what does it lead to? Well, there's several psychological problems all of this can provide or can lead to. One of those problems is that you get a degree of excessive conservatism following the crowd on the upside because you're thinking, oh well, if I get in with everybody else I'll be safe, or on the downside you're letting those losses run. It looks like you're being very conservative by not getting out of a position, but actually what you're doing is you're just holding on to the status quo and letting those losses run and run when you should actually be very stringent and cutting them, and you're not cutting them, and that's the problem. Now, what else does it mean? Well, it means as a psychological bias, we tend to regret things if we made a contrarian decision that went wrong. In other words, if we opposed the market and we weren't herding, and then we were wrong, and we made, say, £100 loss, we'll tend to regret that more than if we followed the market and still made a £100 loss. What's the bottom line of that? What does it actually mean? Well, it means we feel more regret if we lose after switching shares than if the same loss after thinking about switching but don't. In other words, due to our regret aversion, we're less likely to go against the crowd. Due to our regret aversion, we're less likely to sell a stock and get out. And guess what? Those are exactly, in a risk management things, the things you should do. You should go against the crowd. You should be more willing to take losses early. So on a risk management basis, psychologically, not just mathematically, because we're looking at maths earlier, but psychologically, we're more likely to do the wrong thing. And that's why risk management is also about psychology, and that's why I also, on a separate set of CDs, talk about psychology. But, importantly for this point, we have to understand it's not just maths, it's the psychology. We have to set a stop-loss limit and execute on it, and realize that the reason it's difficult to execute on it is because psychologically we're predisposed not to. So, ask yourself, why are you making a particular decision? Are you being objective? Are you analyzing the stock and saying, well, this is where my stop loss is? Or are you failing to make a decision because out of fear? Are you failing to not be managing risk because of psychology? So that's why I don't just want to talk about risk management in mathematics. I want to talk about risk management and trading in psychology as well. It's incredibly important. It's your mind that will screw you up, even if the maths doesn't. Well, that's the end of this chapter, chapter 2, and we'll move on to chapter 3 after this.